What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we are going to be taking a look at shares of Alphabet, otherwise known as Google. All values that you'll see within this video are as of market close on April 15th, 2026. And as always, this video is not investment or financial advice and is solely for entertainment purposes. Let's dive right in here. You can see the past 12-month price chart for Google shares. We're looking at the Class C structure in this case, ticker symbol GOOG. Over that time frame, investors received an amazing 111.51% return. Phenomenal for such a big company and one of the world's largest companies even to date. And you can see that shares are trading above the 50 and 200-day moving average, and there is a technical buy signal still on Google shares with the 50-day moving average, that is the green line, trading above the 200-day moving average, which is in the orange line. So, like I said, maybe a good entry based on a technical buy signal for Google shares. And I think it's important to take a look at the past 2-year chart for Google as well. You can see investors received almost the same return, 115.72% return, and from around April and May of 2024 to around late summer, looking around August 2025, shares of Google trade relatively flat. So investors received almost no return during that time frame. Now there were some legal cases and proceedings going on, which we will touch on later on in the video. But with the possible division of certain segments of Google, such as Google Chrome, this was creating a drag on shares, even though fundamentally the business was still growing. And also on this 2-year chart, you can see that shares are still in a technical buy signal with those 50-day moving average above the 200-day moving average, and shares also trading above both averages. Here are a few key items I want to touch on. The first here you can see is there are 59 analysts that cover Alphabet. They have a target price on average of $378.39, where shares traded on market close of April 15, 2026. You're looking at a price target return of, let's give or take, 13%. Not bad. Now, during this recent run-up, a lot of analysts are lagging in terms of raising their price targets based on the research reports. There's a lot of compliance and regulatory issues around releasing target prices, so there is a little bit of a lag, especially when you have a significant rally since the start of April. The tech sector as a whole and the Mag 7 especially have rallied more than every other sector. You can see earnings per share growth over 26 and 27 of double digits, especially a big boost there in the 26-27 EPS of 17.5% growth. That's a lot of the return on investment capital being realized through these capex, which we will touch on later on in this video. Sales are growing still for such a large company, 15.2% over the past 12 months, a good 10-year trend. But really in that profitability sector, we can see here a gross margin of almost 60%, a good 10-year trend. There were some margins shrinking through COVID, and you can see a big expansion. We'll see that in the sales pictures as well when we look long term. But during COVID and the shift to work from home, Google did experience, especially their cloud business, did experience good and very large growth during that time. And from when we look at that gross margin to net margin, Alphabet has a net margin of almost 33%, an amazing company fundamentally. And when you look at that valuation score there of the trailing PE at almost 31 and the forward PE at 27.7, they're not relatively expensive for the growth that you're getting in the underlying business. Now that price to sales at 10.2 is a little bit worrisome for investors, but that premium, I do believe, is warranted for the diverse business and segments that you're getting in Alphabet, with expanding margins, hopefully, with the realization of these capital expenditures, which should help improve productivity, efficiency, and overall bottom line to expand margins. Over the past 5 years here, you can see that shares are trading slightly above their 5-year average. If we look at the Forward PE of 27, it did reach a 5-year high of 31.6, a 5-year low of 15.3, and that was really at the beginning of 2025. It was a good time to be snatching up shares around then. It does trade it on a 5-year average of 21.7, so you're looking at around 6 beeps higher on the PE, forward PE today on Alphabet shares. But again, this premium, I do believe, is warranted for long-term investors. The price of sales is trading near its 5-year high, and that is a little bit worrisome. I will mention what I'll touch on later is the PEG ratios, which are actually very cheap. And here is a little bit of a valuation comparison to peers of Alphabet. Now you can see Apple, IBM, Baidu, Oracle, and so forth. And on a forward PE ratio, Alphabet's actually trading cheaper than Apple, not that much more expensive than an IBM. And I really question investors, would you rather have IBM or Alphabet ownership based on the growth of both businesses? And IBM has been a significant lagger. They are starting to pick up, but they took decades to transition from a hardware. And actually, it's ironic now there is a bigger need for hardware with the AI infrastructure buildup. When you look at the PEG ratio, Google is trading relatively the cheapest. Oracle is trading very cheap, and we did take a look at Oracle recently, and shares have come up north of 20% since the release of that video, and shares are still cheap during that time frame of Oracle. But right now we're taking a look at Alphabet, and when we compare Alphabet even to Apple on almost every valuation metric, Alphabet is trading cheaper than Apple with better fundamental growth long term. Apple is an amazing company, but when we do an Apple to Alphabet comparison, we'll say here we would rather have Alphabet as owners based on underlying business fundamental growth. And here's what I was talking about. You can see here just a little bit of a snippet of the sales growth I'll touch on first. And that's what I was mentioning before with that 2021 sales boost. Because of that transition to work from home, there's a lot of spending on cloud infrastructure for all businesses. Look at yourself as an employee per se, you may have transitioned to work from home, and that cloud infrastructure capacity needed to be expanded for all businesses across all types and sectors. So Google and Microsoft Azure and AWS as a whole did experience a large boom. But as a company relative to the index, sales growth for Google have essentially outperformed every single year except for 2022, which does make sense. When you have a significant boom in the prior year, you will have a scale back there. And 2022, if you do remember, there was a perfect storm with the start of the invasion of Ukraine, increasing of interest rates, and monetary and fiscal policies tightening. And you did see that in all businesses. Alphabet is not immune, nor are they insulated to macroeconomic factors. But you can see net income growing, the EBITDA growing phenomenally, and should continue based on the past quarter's projections, continue to grow in years to come. And here's just a little bit of a snippet. You can see all these 10-year trends trending beautifully for Alphabet. You can see sales revenue growth of 17.2% as a compounded annual growth rate over the past 5 years and 18.5% on the past 10 year. That is amazing. You're looking at EPS growth in near almost 30%. Net income always increasing year over year, almost 30%. Unusual expenses decreasing because they're forecasting and able to forecast better on their financial costs. And we're seeing operating income also growing. Fundamentally, Alphabet is looking like a juggernaut. Now, I want to touch on some key points here for both bull and bear cases. I do think that is important to take a look at. And we'll start with the accelerating cloud dominance of Google Cloud. Now, their revenue surged, growing at nearly 50%, 50 year over year. That is incredible. And what's more important is that the segment's backlog reached $243 billion dollars at the start of 2026. Listen to this, guys. A 161% increase from the prior year. That is outstanding. Now, bulls will say that Google is no longer just a search company, but an AI infrastructure powerhouse with long term, high margin enterprise contracts. They're not just an AI company, but they have so many different segments through their deep search and deep mind, Waymo, YouTube with its entertainment segment, and so forth. So Google is not just a search company, it's not an AI company, but based on the different segments and underlying businesses of Alphabet as a whole, this is attractive long term and should mitigate risks. If one sector, say the autonomous driving of Waymo, does not come to fruition as intended for Google, they have these other segments that they can fall back on. And well, when 2022, when ChatGPT came out, there were fears that chatbots that would come out even in the future would eat Google's lunch in the search space. But that couldn't be further than the truth, as engagement has actually reached record highs. Features like AI Overview and the Gemini 3 integration have actually strengthened the core advertising business of Alphabet, which grew 17% in the most recent quarter. Now, the AI mode on Google Search is providing and proving to be a very good value add that increases user stickiness rather than a threat to Google. Now, that I believe is a very important feature to have, and the proof is in the pudding when you see engagement and searches reaching an all time high. And the operating leverage and valuations of Google, depending on what you look at, like we said, the price of sales is a little bit overvalued. But when you look at the price to earnings growth ratio, that remains below 1. And that's evident if you're looking at it from a bull's lens that the market is actually underestimating Alphabet's growth potential relative to its price, making it cheap relative to peers like Microsoft and Meta, and like we saw there in in Apple as well. Now, bears are going to say there is that $180 billion question, and rightfully so. I will say Alphabet did shock the market by doubling its capital expenditure guidance for 2026 to between $175 to $185 billion. Now, Meta came out with lower numbers closer to $135 billion on the top end range of their capex spending. And the market did reward Meta. I will say they do have a good return on investment capital track record, which we did touch on in a previous video. But when we look at the arms race right now, and we look at other companies like Microsoft and OpenAI, bears will actually say there's a no-win scenario. In fact, Alphabet must spend money just to stay relevant, which could severely depress free cash flows and margins for future years, and there's no return on invested capital and no guarantee that you'll see positive or even any profit with these capex of 175 to 185 billion in various AI infrastructure buildouts. And I will say that Alphabet does have the cash to support this. They're not actually going out to the open market and issuing high interest debt. We are seeing yields rise in the fixed income market, but Alphabet does have a treasure chest of cash that they can rely on to fund these expenditures. So that is actually a good caveat for Alphabet. Now, that antitrust case that I was mentioning before is not really put to bed, as the DOJ and the EU do remain aggressive with ongoing discussions regarding the forced divestiture of Chrome or like I mentioned before, structural changes to the search model. Now, bears worry that even if Google wins on technology, a death by 1,000 cuts, they say, I believe that was the Wall Street Journal, did mention that the death by 1,000 cuts from global regulators will eventually break the high margin moat that funds all the other initiatives like Waymo, like DeepMind, and so forth. And there is a little bit of a worry about the ad market saturation. While search is still strong, YouTube ad revenue has recently shown, now mind you, very slow, very small signs of missing estimates as advertisers become more selective on where they allocate their dollars. And with midterm elections and major sporting events like the Olympics and the World Cup that's coming up in the summer already priced in, any macroeconomic softening in the back half of 2026 could lead to a sharp pullback as some valuations, like we mentioned, the price to sales, can result in a very rapid deterioration of share price or extended volatility if macroeconomic headwinds persist. Now, fundamentally, Google is still growing. We must look at it from a bear lens and a bull lens as well to get a non biased thesis for our investments in Alphabet, Google, and any company going forward. Now, I thank you guys for making it to the end of the video. Please do hit that like and subscribe button and stay tuned for the next video.